Inflation around the world is not going away, and central bankers have no idea what to do beyond yet more panic hikes in the dark. In the past few days, the Bank of England hiked another 50 basis points, that's 0.5%. Norway also hiked 50 to defend its sliding currency, in other words, domestic inflation. Switzerland piled on another 25 points, its 11th hike. Turkey hiked 6.5% in a hopeless defense of its plunging lira. Australia and Canada recently imposed surprise hikes. The European Central Bank just raised rates again, and I've mentioned the Fed is signaling yet more hikes to come. I have been talking recently how core U.S. inflation has been stuck for 6 months straight. The EU and Britain are even worse. Across the wider OECD group of 38 rich countries, core inflation has been stuck above 7% for almost a year now. And yet, rates have been soaring around the world, the standard central bank playbook, how to fight inflation. Those rates have managed to slow their economies to a crawl, held up by little more than accumulated savings during the pandemic when you couldn't leave the house. But even that is fading. The Eurozone just entered a, quote, technical recession, while U.S. growth has been negative in 4 of the past 5 quarters. Stuck inflation is a central banker's worst dream. They know that inflation is how they're graded by voters, meaning if inflation is too high, too long, they will lose their independence. They'll get taken over by the legislature, hence the panic hikes. Of course, the problem is that inflation worldwide is being driven by governments spending too much money, yet central banks are trying to cancel it not by telling those governments to live within their means, but by crushing the private sector. This apparently is not working. Yes, it is crushing the private economy. It is not actually ending the deficit-driven inflation. At this point, the challenge for central banks is that on the one hand, they are desperate to kill inflation, but they also know that there is a long lag on hikes. It can take up to a couple years for rate hikes to show up in the economy. So they risk going too far. Essentially, they are driving at night with no headlights, but they're desperate to stomp on the accelerator. Stepping outside central bank fantasy land, 500 years of classical economics, today known as Austrian economics, sees things very differently. That durable inflation is not mass illusion. It is not Putin or stuck boats in the Suez. It is printing metric tons of money. The rich world did this to buy COVID lockdowns. It took a lot of sweetheart loans and public handouts to buy public support for lockdowns. And at this point, although the printers have calmed down, a lot of all of that fresh money is about $9 trillion worth. It was saved, and so it is now gradually bleeding out into circulation, in other words, into inflation. Unless all those fresh trillions are soaked up by slashing government spending and by central banks selling off government debt, it will keep leaking out while central banks keep panic hiking into an abyss. Okay, we'll be watching. See you next time.